Hello to everyone. Today I am here with Time Value of Money, Lecture 2. If you are interested to have updated videos on banking and finance related topics, please do subscribe my channel. In the previous lecture, we have covered the future value by applying simple and compounding interest method. The formula for the compounding method is PV naught 1 plus K power, and that this formula we have also derived in the previous lecture. And thereafter, we have also calculated the effective rate of return for the periodic payments for the periodic payments by Planck simple interest method. Today we are going to discuss, first of all, the present value or the discounted value. Here, I'm going to start with a practical example. A builder offers a flat against the agreement to pay 7 million after 3 years. Give your comment either you should opt for the agreement or not if the expected rate of return is 18% and the present value of similar flat is 5,500,000. Now here, what is given in this question here, future value after 3 years. If we 3 that is equal to 7 million. The term is 3 years and the rate is 18%. Now you will have its present value, you will have to calculate its present value and compare this present value with the present value of a similar flat as of today. We have the formula for the future value compounding. From this formula, we will derive present value formula. It will be equal to FVN divided by 1 plus K power N. Here the future value is 7 million, 1 plus K is 18% and term is 3. So here we calculate the discounted value of the flat that we have to pay after 3 years. It's 7 million, and by applying the interest factor that is 18%, the value comes to 4.2 million 60,499. That is less than the present value of the flat, of the similar flat, that is 5.5 million. So we should opt for this option. Our next concept is annuity. First of all, what do you mean by the annuity? Annuity is equal series of payments, likely monthly equal installments payable against vehicle finance for a period of 3 years, means 36 equal monthly installments. So similarly, annuities can be quarterly, can be semi-annual, can be annual. There are two types of the annuities. First is the ordinary annuity, also called as end mode or in arrear. We can say ordinary annuity, in arrear, or the end mode are interchangeable words. So in case of the ordinary annuities, all the payment will be paid at the end of the term. For example, if the mode is monthly, payment will be made at the end of every month. If the payment is quarterly, payment will be made at the end of every quarter. If the payment is semi-annual, payment will be made at the end of every semi-annual. Here we have an example. What is the present value of annual ordinary annuities for 50,000 for a period of 5 years? Consider the interest rate is equal to 12%. Here, first payment is made at the end of first year, that is T is equal to 1. Second payment is made at the end of second year, that is T is equal to 2. Third payment is made at the end of third year, that is t is equal to 3, and fourth payment is made at the end of fourth year, that is t is equal to 4, and the fifth payment is made at the end of fifth year, that is t is equal to 5. Now, you are going to calculate its present value. For the first payment, term is 1 and the rate is 12%. The amount comes equal to 44,642.86. For the second year, it will be divided by 1 plus 12% power 2. Answer will become 39,859.69, and for the third year, it will become 35,389.01, and for the fourth year, it will come 31,775.90, and for the fifth year, it will become 28,371.34. So, in case of the ordinary, the present value, the sum of all these values are equal to 180,238.80. Okay. Later on, we will also solve this question by applying the formula and on the Excel sheet as well. The second concept comes annuity due, also called as the beginning mode or in advance. We can say that the annuity due in advance or beginning mode are interchangeable. For example, payment is made monthly. Payment will be made at the start of every month. In case if the payment is made quarterly, payment will be made at the start of every quarter. If payment is made semi-annual, payment will be made at the start of every semi-annual. Now here we have the annual payments. What is the present value of annual annuity due for 50,000 for a period of 5 years? Consider interest rate is 12%. Here the annuity is same and the rate is same, but the phenomena will be different. First payment will be start in the beginning of the year at t is equal to 0. Second payment will be start at the beginning of first year. Third payment will be start at the beginning of second year. Fourth payment will be start at the beginning of fourth year, and fifth payment will be start at the beginning of fifth year. Either you can say end of first year and the beginning of second year here, end of second year, and that is the beginning of third year here. It's the end of third year and the beginning of fourth year here. It's the end of fourth year and the beginning of fifth year. So for the first year, the time you are going to invest, it's the 0. So this value will remain the same or directly adjusted against your liability. In case of a second year, you will divide it with 1 plus 0.12 power 1. For the second year, you will divide it by 1 plus 0.12 power 2, and for the third year, you will divide it by 1 plus 0.12 power 3, and for the fourth year, you will divide it by 1 plus 0.12 power 4. So in this case, the calculation comes to present value annuity calculation comes to 102,867.46. Now, in the coming lecture, we will solve these questions by applying the formula, and see you again with the next lecture related to the time value of money very soon. Thank you very much.